Good afternoon. Welcome to Chicago, Future of Finance. I'm Olive Renick. We are live from Cboe on a bounce back day. We continue to buy the Greenland dip. I'm thinking this might be one of the funniest geopolitical sell-offs ever. Don't call it off too soon until we get to the highs, but things are looking pretty stable, and generally geopolitical drama is the best dip buying opportunity there is. And were we really gonna crash the AI-driven bull market because of Greenland? I don't really think so. The economic data is looking pretty solid. GDP looking pretty good. You got yields that blew out earlier in the week that kind of spooked folks a little bit, but there's a good chance that if data keep coming in solid, then you could have yields moving higher for the right reasons. That's why I've had yellow on stocks and yellow on Bitcoin to see how we process some of this volatility, but generally a very good situation as we've got some key groups that are working. Notably, the Russell 2000 and the small caps, which has been a focus of our show here over the last couple weeks, looking at the IWM breaking out to all-time highs, big move, rotation, and a little bit of dispersion among the winners of the market. Keep in mind yesterday too that we had big moves in Intel, Micron, winners in the semiconductor trade that had remained solid. But look at the small caps with the Russell really jamming here, 270 in the IWM and the Russell 2720. VIX also pretty stable, retreating back down below 16 to 15.6. A little uptrend line in VIX that now we've broken to the downside. The show has been all over it. I think a week ago, Brent Kochuba told us that VIX looked like it needed a little short-term pop to get in line with some of the single stock volatility in the market. We've also been covering the metals trade as the most reliable with the green light for gold, the only one on my risk radar with that green means go label because the chart just doesn't lie. Look at gold and silver continuing to run basically regardless of what the environment is. So there's some good things here. By the way, bonds are selling off, but just the tiniest bit. As I talked about yesterday, don't expect us to move back through 4.2% too quickly, I don't think. There could be good reason to have the yields a little bit higher. I don't think a big reason to panic just yet, even though there was a little political discord around Davos between us and Europe. The numbers still look like they favor the United States, obviously, as the leader on the economic front. GDP coming in at 4.4% was a little bit above the expectations. So what's not to like there? Again, I think there are signs that the bull market could get right back intact after just a little bit of a brief hiatus from the straight up movement that we've had. GDP, worth a look. Not bad, right? 4.4 PCE in the GDP, also stable in line with expectations. So I think that generally we're pretty happy with the outcomes right now overall in the market when key groups and key leaders like Tesla and NVDA held the lines that they needed to hold. That's really important. So without further ado, let's bring in Mr. Brent Kochuba joining me from SpotGamma. Brent, last we talked, you were looking for a little bit of a pop in vol to kind of equalize some of the metrics between index vol and stock vol. So did we get it? Did we normalize? Or what are you looking for right now after we did get a pretty decent spike in VIX?
I think, Oliver, as you mentioned, we were talking about correlation and the core 1M being so low about 10 days ago, and that being a concern for risk. And not coincidentally, I think we see the risk spike. The VIX made its low at that time. We were talking about VIX around 15 and went up to the 2025 area into this Greenland situation. And that seemed... Let's just call it dirty. So that seemed to have cleared up with VIX expiration, which was yesterday. Now the problem is, as soon as everything seemed to be cleared up, Oliver, now we're right back to where core 1M, that correlation metric, is all the way back down to lows. The VIX, as you mentioned, is coming back down. And so we kind of have this situation where maybe the bulls are a bit over their skis. I mean, the bid is like binary, right? It's like bid went off, now bid went fully back on. We have FOMC next week, which a lot of people are saying shouldn't be a big deal. We still have the criminal investigation around Powell and some of those things, so maybe there's a little bit of a tail risk there. We have single stock earnings in focus, or earnings are in focus with the single stock side. So unfortunately, you know, we didn't really clear up the imbalance and volatility much, despite the 2% equity drawdown.
Okay, so the fact that we did get this move, but there are still kind of maybe some things that need to be worked out, some tweaks maybe. There's a lot of single stock dispersion as well, which is important here. When the market was down, we had Intel making highs, we had Micron making highs, and now the small caps that are ripping.
Semis, yep.
Right, so does that kind of fit into what you're describing here, Brent? The
I think
specific things that are going on?
Yeah, you're right in that ultimately these stocks making new highs and a lot of these sectors, making new highs are indicative of the fact that people are very bullish, right? And they're buying calls, and that is driving up single stock implied vols. If you look at the memory names, SanDisk, LRCX, Micron, those names are all ripping with very high levels of volatility, implied vol, right? So, if you just look at SanDisk as an example, highest IV we've had in a year in that name. And so the situation as we head into earnings is IV rank is 90+%. The stock is up, 300% or whatever it is this year, right? In the first month of the year. And they have earnings next week. What type of earnings revelations have to be made to justify both that price move and work with that elevated level of implied volatility, right? So the issue here is about expectations and rate of change, and the expectations are sky high for a lot of these winners, and it's very hard to meet those expectations, right? So the way that you would frame this is like the trend can still be up over multiple time frames, but the rate of change has been too high, and we're likely too rich in terms of the call skew or call implied vols.
Okay. So, Brent, should we be having single stock sort of hedges against index positions, or what's the ultimate kind of trade implication for this?
The fact is that FOMC is going to be the nearest term catalyst, I think, for this market. So for tomorrow, Friday, Monday, Tuesday, I think you're going to see people still pound the short-dated S&P implied vol lower. Short-dated, talking about 1-2 DTE, and the SPX is trading around an 8% implied vol. That's about as low as it gets. And quite frankly, if you're a 0 DTE or very short-term trader, that makes sense, right? There's not a whole lot of reason to expect a lot of movement out of the S&P before FOMC. And so what you do when you sell that index vol is you buy the single stock vol. And so this trade is likely on for the next couple of days, and then we're going to hit a risk window with earnings in FOMC. Now, maybe earnings in single stocks are great, and maybe FOMC is benign, in which case then, we likely look to that S&P 7,000 level. But if we break that 6890 level again, which was our risk off level last week, then we also just have to realize that the dynamics of volatility mean that, look, volatility can leak out, things could get jumpy just as they did last week, and we could see a pretty sharp correction or drawdown in the equity space due to the fact that these implied vols are so offside. So just to summarize that again, I don't see any risk for the next couple of days here in the equity market. If S&P breaks 6890, I think that's where we have to go risk off. And I think the way you hedge this is with VIX call spreads is a great way to do it. That vol can spike pretty quickly, and I think that's a very clean way to play any type of a correction in the equity market.
So we kind of had, it's basically a repeat of what we saw from that relationship when Core 1M dropped down below 8. That's when you put it on our radar to look for kind of these short-term spikes in VIX. We got that. Now VIX is settling back in. The Core 1M is also dropping again. So it's kind of like we're repeating a little bit here, which might be a healthy way to kind of clear out whatever sort of temporary froth there could be in the market.
That's exactly right. And look at the screen today. We're between 6,900 and 6,950. The S&P for most of January spent in that range, right? It was a very dull market for 2 weeks on the S&P side. CPI, we went to 69.75, almost took out the 7,000 level, and we retraced that intraday right back into this box, this 6,900 to 6,950 box. So I don't think we leave that box until FOMC. If FOMC is totally fine and earnings are good, then maybe we finally go for that 7,000. And then to that downside, again, no reason to guess. Just if we break 6890, that's where that risk off sentiment can flare again. And so, again, I don't think that's going to happen these next few days. But to your point, Oliver, we're right back to where we are. And so the risk off levels are going to be the same as they were basically a week to 10 days ago.
Looking at the kind of heat map that you've got on Trace, which I think shows where we could have those levels that you're highlighting, kind of pinning us in to watch to see if we break, okay, 6890, 6900, then it kind of looks like maybe more of open range. Love that on the index level, Brent. Give me a couple of thoughts on the tape here with the single stocks and the assets that are moving, because I still see a few of our favorites up there. SLV, namely, top options volume, 1.4 million. And look at the IWMs. That was a real key part of our conversation last week. We talked about the potential for small caps to take a short-term leadership. That was something on Danny Kirsch's radar. Talked about with Noel as well. I mean, a lot of the things that we've been kind of looking for coming to some fruition here, and I think it's also encouraging that when we got this dip in S&Ps, it just kind of transferred the strength over to the small caps that are making new highs.
Yeah, and on that point, Mag 7s have not really done that much, maybe except for Google, right? And here we are, equities still just off all-time highs, because there's clearly a rotation, and that rotation is not just amongst large caps to small caps, but also, again, out of the Mag 7s and into the memory names, for example, those types of trades. Defense, all these other names are still doing really well. The commodity space is getting very large, so the metals in particular, obviously SLV and gold is there, but that draws into the single stock complex as well, right? Mining stocks or other related names are catching a bid, and those can be meaningful to lifting the S&P as well. So, there's absolutely sectors of attack, so to speak, with call buyers and options flows moving in. And it's very hard to want to be short the market over any long-term time horizon when a lot of these sectors seem to be breaking out, right? And so really ultimately the problem here is with rate of change and being overbought, which is different from a topping signal, right? And so I think, you frame that is important. But, silver, gold, still huge. We have, again, earnings starting up next week, and so I think that's really big, and that, to me, is what is most interesting. You get SanDisk and LRCX, which are these memory names that are going to report on next Tuesday and Wednesday, and so I think that's going to be a huge signal for those, for that AI kind of semi-complex. But ultimately, there's still just this kind of almost like flight to safety in some ways in silver and gold, which Venezuela seemed to re-engage. Then this Greenland thing, I think, also re-engages that trade. And so, we see a lot of short gamma or negative gamma in GLD, for example. There's a huge call spread in place right up into that 465 in GLD. So the options complex is getting really big in these ETFs, and that trade just will not die, right? There seems to be a lot of flow left in there. And I think you don't want to short these gold and silver stocks yet.
Yeah, I mean, it's an incredible chart. It just continues to find new momentum with every brief moment of consolidation like we got earlier this month in GLD, RIPS. I kind of thought FCX, Freeport, was going to get caught in the mix, but I don't see it in any of the top options volume. I thought maybe that would be a big swinging move on earnings, but it's kind of ho-hum today, down 2%. But, I mean, we know the metals leaders. Gold and, silver, too. It's just extraordinary to see that momentum.
Nickel now. Nickel's
stop.
Another one, so, yeah.
Yeah.
All these metals are really moving, and so, those stocks, I think, are also going to be really in play as well. The related stocks. And so something to certainly keep watching is that tailwind just seems to continue with all this geopolitical intrigue.
Yeah, for sure. Intrigue, AKA dip buying news flow. Brent, thanks for the thoughts. Appreciate that. Good place for us to wrap, because our next conversation is going to be a little metals heavy, but also mixed in with crypto and how to balance it with stocks, or should we say stacked. When I said the show was stacked, I meant guest-wise, but also topic-wise. 2 new ETFs listed at Cboe here through Quantified Funds and sub-managed by Zed Francis at Convexitas on deck to join me here from the floor after the 2-minute innovator buffer break. We'll be right back.
With increased volatility, investors are bracing for large market moves, both up and down. Will the market rebound 30%, or will we see a 30% drop? At the end of the day, uncertainty remains a constant. Innovator's floor ETFs are designed for volatile markets. They aim to position portfolios for market moves regardless of direction or magnitude. They are intended as a core equity solution, providing exposure to U.S. equities with built-in downside protection, seeking to deliver more than 70% of the upside and targeting a max loss of 8 to 12% annually. With specified levels of sought-after protection and upside participation, we believe the floor ETFs offer an evergreen strategy designed to allow investors to remain invested regardless of the market's direction.
There are two things about Chicago finance you can't get anywhere else. The first is kind of hard to miss. Everyone's trading options. Cboe is on a 5-year growth streak making billions, and its goddess of grain sits atop the final pit of open outcry. And that's what it's all about. The chance to fend for yourself. A fortress for the self-made trader, and the only still standing in America. The second thing you may not know, but it's worth trillions. Chicago is the only major city in America that's home to 2 of the top 10 registered investment advisors, according to Barron's. That means a steady river of passive money and fixed income pouring into the city. If you think you can beat the market, this is where you do it. If you've got value, price will discover you here in Chicago, the future of finance. Join me, Olive Renick, from Cboe, Tuesday, Wednesday, Thursday, into the closing bell, live from Chicago. Welcome back to Chicago, Future of Finance. I'm Oliver Renick. I'm here with Mr. Zed Francis, joining us as CIO at Convexitas. Second time here on the show, back, but with some new funds that you're managing, Zed. Great to have you. Good to see you again.
Thanks as always for having me.
Okay, so this is very exciting because we're hitting a lot here. We're talking about this move in the metals that's been huge, but this is also really about ETFs and the way there is a new kind of way to package things, which is the idea of stacked ETFs, stacking assets, or you could do it with anything. There's, I think, Corey Hofstein sort of was the pioneer of this concept. You're working as a sub-advisor to quantify funds on a few new stacked ETFs. Tell me firstly what exactly it means to have a stacked ETF. What does it do?
Yeah, so the concept of portable alpha has been around for decades. Like, in fact, even PIMCO launched a portable alpha mutual fund, like, I think early 90s. So it's not a new concept. It's just rebranded. As you said, Corey has done a fantastic job with the rebranding. And ultimately, it's trying to staple 2 return streams together. So you're getting 2 return streams for each dollar invested. Okay. So traditionally, they'd be like, S&P 500 with some alts category, where somebody doesn't want to allocate enough money to some sort of alts category, but they're like, oh, I don't want to give them S&P, but I can add it on top of it. What we're trying to do is allow investors to incredibly efficiently, from both a tax perspective and a financing perspective, get access to 2 different return streams per dollar invested. And the first 2 that we launched are ISSB, which is stocks and Bitcoin, $1 of each per dollar invested, and ISBG, which is 100 cents of Bitcoin, 100 cents of gold per dollar invested. But essentially, again, stapling 2 different return streams together with $1 dollar invested, trying to maximize the cost of financing. We do, like, in an ETF wrapper, you get way better cost of financing than you would just in your own account at Robinhood, Schwab, or whatever. But then also we get massive tax benefits within the ETF wrapper that you wouldn't be able to achieve just in your own account.
Okay, so when I hear getting more bang for your buck, basically there's some leverage, there's some margin play here. So is that a right way to describe it?
Yeah, so that's a great transition. So, if you just were buying, 2 ETFs on leverage or futures of 1 each on leverage, then that leverage within the product, it might create problems during downdrafts. So you're like, okay, I got 2 return streams that I believe over the long haul, keyword long haul, 10 years, are going to have very good returns. So getting access to both of them per dollar, that should result in better outcomes. But your issue is, if the market experiencing a correction where both of those assets go down, you actually have to de-lever, right? You start losing more per dollar for each of those return streams. You actually have to de-lever on the way down, which ruins the idea of compounding for the long term. That's why we're launching these ETFs using options to generate that exposure to those two asset classes. And we've designed the structure to have some natural breaks in there. So when you have a violent a la first week of April pullback, rather than fully experiencing 100 cents down for each asset class, the exposure starts declining on the dramatic events, and those breaks allow us to not have, hopefully those dramatic delivering events when ultimately you want to be, frankly, probably over the long term adding risk.
Okay. By the way, context, there's a reason we're doing this here at Cboe, because these are Cboe listed funds.
They are.
And that means that this is the exchange traded profile of the day, sir. And congrats on the debut here, because I think that this pairing that you guys have gone for is a very, very good one. ISBG, Bitcoin, and gold. Let's start there with the details. I'm going to pull up some of the literature on this because I think this is really important. I had done some research about this years ago and trying to kind of disprove the way Bitcoiners talked about Bitcoin being gold. And in fact, what I found out is the way they trade against real yields, they actually become great complements to each other. So I think that this makes sense for a lot of people to balance risk with Bitcoin and then some stability with gold. Is that how you think about it? And how does that imply who should be using this and for what?
Yeah, absolutely. Again, we're trying to allow you to get access to both these asset classes where you're getting $1 of each per dollar invested. But then the bells and whistles of it are, again, why we're using options to have a little bit of that decelerator of risk, a little bit of a buffer on the way down when the dramatic events happen so you don't have to delever. The other side of it is we're trying to harvest volatility risk premia, i.e. we think that the implied volatility embedded in the options of these asset classes is elevated in comparison to how much the market's actually moving. And we're trying to capture that spread and embed that as a return stream within those products. And then the final one was what you were alluding to. When you have two different return streams and you're targeting equal weights in both, and one goes up and one goes down, what are you going to do? Well, if we're doing it correctly, we should rebalance. We want to keep getting it back to approximately 50-50 exposure and get you access to that rebalancing premium of two asset classes that potentially move, dissimilar fashion or potentially even in opposite directions during stressful events.
Okay, now this is important because you not just have the exposure to the two assets, but you also have the income side with the option side with as well. So you've got layers on layers here basically going on. So you get the income side, which has obviously been quite popular, but then you also have the side of it which is just the exposure to the assets too. So you're kind of hitting a lot here. You could kind of say that this is going to appeal to a trader or an investor, an RIA who wants the Bitcoin exposure, the gold exposure, but then also wants some of the degrees of maybe, do we call it security that comes with kind of income, or is it more like an additive?
Well, I think a lot of folks want to add Bitcoin and gold to their portfolios, but what is it replacing? And most likely it's probably in the bonds quarter. Like that's what they're probably using as an alternative, some diversifier, something different than equities. Is probably replacing bonds. And the issue when you're replacing bonds is obviously removing those distributions from the holistic portfolio. So we wanted to have something that was, again, very efficient from a financing side of things, allowing the client to maybe only allocate 5% of their portfolio to this, where they get 5% of two different return streams that they want within that portfolio for that same dollar, but it's still going to go ahead and hopefully create those distributions similar to what they're replacing in the bond side of the house.
It seems like a lot of things on the product side being created right now are trying to target the bond part of the allocation. Everybody thinks they've got the solution. And what's good about this, I think, is it takes basically kind of three of those solutions. Because here's what I see as the main solutions that have been offered to fix the bond problem. One is options. People say, okay, just use income instead. We like bonds for income. Options give you income. The other one, of course, is the gold and the Bitcoiners, which kind of two different sides of the same coin, if you will, where they say, well, you just need to have this sort of like other thing in there, the shiny object, if you will. Then you've also got the private market side, which is saying, well, you should have private assets in there. You should have a diversifier. We bring something to the table there. So with the exception of that one, you're hitting basically kind of like all the other three solutions to the bond problem, if you will.
No, I think that's right. I mean, I think everybody knows the issue with bonds is you're probably not getting compensated enough for the risk you're taking in comparison to the taxes and inflation that are involved with it. But historically, people believe that bonds are negatively correlated to equities, but they haven't been for 5 years. So we're all searching for that diversification, but still need income. And we think these avenues are good choices to build into that portfolio.
Okay. Now, how will you kind of manage this? Because you're the trader behind this. David Jacansky's Quantified Funds is the home base for the ETF.
Yep.
You guys at Convexitas, the sub-advisors, and obviously your options pros. That's what we've talked about before. So this is your sweet spot to do that. But when it comes to, I think, Bitcoin in particular and trading around that, how much is predictable in terms of the way this is going to trade, the way that you're going to have to respond to how Bitcoin's correlations change? Because one of the big things that I realized in my study is that gold's relationship with real yields is very reliable over time, generally. Now, gold in the last year has been going kind of berserk on its own, though, where some of those have even started to fray. But if we take Bitcoin, for example, its relationship to stocks, its relationship to gold and bonds has changed quite a few times in its shorter-lived history.
Yeah.
And who knows what will happen? Like, what will happen if, MicroStrategy suddenly blows up, and then you have this idiosyncratic risk. So how much of that is predictable, and how do you move around that unpredictability?
Yeah, no, I mean, it's a young asset class that's slowly maturing, and as it's maturing, as you say, its correlations are morphing over time. So, we're not going to put a stake in the ground and be like, we think it's going to be positively, negatively correlated to anything else. Where we see it being really interesting is we see the edge on the volatility side in the asset class to be incredibly interesting. So if you're looking to add some flavor of Bitcoin to your portfolio and doing so in an efficient way without replacing stocks, for example, just being additive, we think we're able to create additional value while giving you that beta that you want, that return stream into that portfolio in a very tax efficient, capital efficient manner.
Okay. Now, since you're talking about stocks too, let's talk ISSB here. A little bit different, same concept, right? But this is stocks plus Bitcoin. So for me, this seems like it addresses a very different user, which is a little bit more kind of pure risk to some extent.
Yeah, and I think that's probably true. Frankly, all of them are probably considered to be risk assets. Although, as you say, gold tends to have a little bit more deviation to the path to equities than potentially Bitcoin has in the past. Other than, I guess, last year, Bitcoin and stocks didn't exactly partake with each other as most people think. But yeah, if you're looking for if you're like a younger investor that's looking for a long-term hold within your portfolio that's going to have a little bit of embedded leverage, but also create distributions to allow you to potentially help subsidize lifestyle expenses, like this could be a very good tool within your portfolio. Or if you're somebody that says, I love stocks, but I want to add a little bit of Bitcoin, well, let's just replace some stocks with the stocks and Bitcoin allocation. That way, it's addition without subtraction to that portfolio.
Okay, so that's an interesting point. And obviously, you still have the income side, the options side here. It seems like the main kind of value add of these is you can hit a couple birds with one stone for your portfolio, whether it's exposure to a certain asset class, the income side of it, which is options driven, and then also, I think, it depends if you're looking at ISSB or with gold, but you're also kind of hitting that diversifying of the portfolio a bit.
Yeah, and ultimately what we think we're bringing to the table is we're risk managers, not strike sellers. And ultimately what that means is, your average ETF in the, we'll call it income sphere, they're buying S&P 500, they're selling a call against it. So theoretically, if you did that last week, Friday, you bought the S&P, you sold a 1 week call to generate some sort of distribution. When you went home on Friday, you probably had 66 cents on the dollar risk per dollar invested, i.e. 2/3 of the risk. Tuesday happens, market goes down 2%. Well, what happened to the ETF? Well, your exposure went from 66 cents to like 95 cents, right? They're just strike sellers. They're going to wait for a week for that to happen. So as it falls, that call no longer has as much risk. It's further out of the money, meaning your risk changed dramatically. Your risk actually increased almost 50% on a random walk. What we're going to do is we're targeting that 100 cents risk in each asset for every 100 cents invested, and we're going to be rebalancing to get ourselves back to that point. So with us, it's as simple as what you own. Like, the risk that you hold when every time you buy this rather than some random walk. And because we're keeping that risk constant, we're actually harvesting volatility risk premium. We're not just selling a strike and like, hey, does it win or not as time rolls off?
Right.
We're actually capturing the spread and volatility in terms of what's in the option versus what's realized, and that's a more persistent value add rather than throwing a dart.
Trying to, yeah. In fact, the last point here is I got this up, the portfolio construction, breaking it down into 3 parts, and we're still on Bitcoin and stocks here. Long flex call options for beta, and then your short call options for premium, short put options for premium. The use of the flex options here, which is also kind of an additive. You guys, this is kind of like a cocktail of like some of the hottest stuff right now, basically, in terms of product innovation, because flex options are already very popular for a lot of different funds, buffer funds, et cetera, and stuff like that.
Right. I mean, the point of the flex option is it allows you to roll the option. We're getting kind of close to maturity. I need to kick out the tenor. If you were doing that just in your own account, that experience would result in a taxable event, right?
Okay.
So if we think market's going up, this is a long beta fulcrum, that means, every 6 months I have to pay taxes. Nobody wants that. Within the ETF wrapper, if you use flex options to generate that beta, we can do something called a heartbeat trade, which essentially is a create redeem of a single basket of options for another basket of options. No real necessarily need to dig overly into the complexity, but what that allows you to do is transition from the current option you're in seat A into a new option in seat B and have essentially the original cost basis carry forward. So it's not a forced realized event. So that's why you're seeing these options in these ETFs, is that it allows you to use options for market exposure without creating forced taxable events.
All right, which is also a big part for the advisor market too, is just you don't want to have to keep creating taxable events. That's, I mean, where a lot of people already are not treating the options properly, which creates drag. And then the tax events are creating additional drag.
Absolutely. I mean, taxes are, probably more important than value add at the end of the day.
Yeah. All right, love it. I think a real kind of mixing pot of a lot of things that we've spent time talking about here, whether it's flex options, if it's crypto pairing with gold or stocks, and then also the idea of generating income with the stacked structure of the ETF. So it's going to be fun to watch how they trade, who takes interest. ISSB, the one we were talking about with stocks and Bitcoin, ISBG for stocks, or for Bitcoin, and gold, rather, from Quantified Funds, managed by Zed Francis at Convexitas. Always a pleasure to have you on the show, Zed. Good to catch up.
Yeah, thanks, Oliver.
Congrats on the launch of the Cboe funds here. All right, when we come back, let's talk some more about the commodity trade. Going to one of the best shops to do it. Blue Line Futures, Phil Streible up next. Short break. We're going to get into the biggest winners really here of 2026 so far. They were winners already last year, and it just keeps going in the commodities. We'll be right back.
With increased volatility, investors are bracing for large market moves, both up and down. Will the market rebound 30%, or will we see a 30% trap? At the end of the day, uncertainty remains a constant. Innovators' floor ETFs are designed for volatile markets. They aim to position portfolios for market moves regardless of direction or magnitude. They are intended as a core equity solution, providing exposure to U.S. equities with built-in downside protection, seeking to deliver more than 70% of the upside and targeting a max loss of 8 to 12% annually. With specified levels of sought-after protection and upside participation, we believe the floor ETFs offer an evergreen strategy designed to allow investors to remain invested regardless of the market's direction.
Welcome back to Chicago Future of Finance. The story, arguably, of the year was gold and silver's big run. And with 2026 now almost a month in, it looks like it's still going. Fresh highs today for both of them, silver and gold. So let's go to one of the best commodities traders and groups that I know, Blue Line Futures, based here in Chicago, with Mr. Phil Streible joining us from Florida. Phil, great to see you again. Thanks for coming on the show.
Yeah, thanks for having me on.
Hey, this is arguably the story of 2026. You know, last year was like we could pick a lot. The AI story was great. The tariff comeback was great. The retail trader crushing the market was great. But when you take the gold and silver performance of last year and the fact that it's extending this year, it's just unbelievable. What do you make of it?
Yeah, it's incredible. I mean, we believe that gold futures could hit 5,500 in 2026, really driven by the continued central bank buying, the private investor ETF flows, and the Fed easing. We expect 2 cuts in 2026, but it's really those 2 structural drivers. The central banks, they are diversifying away from US dollars, treasuries, other currencies, and they're increasing their gold reserves. We saw that begin in 2022 between Russia and Ukraine. The average central bank holds about 20%, China only about 8%, and where we believe they want to bring that is up to 30%. So that's kind of the first thing. The second thing is that really you're getting those ETF flows, the portfolio diversification. So the traditional 60-40 portfolio, it's just dead. So they're adding strategic commodities out there, such as gold, silver, copper, at times Bitcoin and oil. Really depends on what the situation is, but adding small slices really can help not only protect somebody, but also give them the opportunity to make additional, yield from the rise of those particular commodities.
Silver making highs, gold doing the same, kind of fitting into the conversation we were just having as people are trying to figure out what to put in place of bonds for their portfolio. The fact that we got silver and gold making highs while the 10-year yield broke out certainly fits some of that narrative. But I would also say, yields have been in a downtrend for a year, and these things have been doing well too. So it kind of just feels like, I don't know, I could argue you don't even need the bond story. It's just these things are working as an additive to the portfolio regardless of what you got.
What we're seeing is that people are taking down some of, like, if you have an 80-20 portfolio, they're taking down that debt side of things down to about a 15 or 12% allocation. And then what they're adding is those small slices in there of things like gold, like miners, things that are paying dividends. Even some of the energy names out there have done really well. And it makes up for that. It gives them that income stream they're looking for, but it also gives them a little bit more diversification.
Now, when you look at the potential for, price movement, as you mentioned, you see gold trading upwards past 5K. Silver, is it as reliable? It joined a little bit late, but the move certainly was appealing to those who like a little bit more volatility. How are you thinking about gold, silver on that spectrum? Maybe we throw in Bitcoin as well, which had a weak 2025. But certainly is no stranger to volatility. It's kind of like dead in the water today and yesterday, but look, we know what it can do. We know it can be part of that volatile regime, but I wonder if silver kind of usurps this. How did those things fit on the spectrum in your mind?
Silver's really interesting because I believe that at some point you're going to see some substitution risk from the end user in silver, but as far as this price action from the $50 to $95, 50 before, that was the old ceiling. We broke through it, and it seems like it's just a perfect storm here where prices could drive up into the triple digits, and it could potentially happen tonight. Futures got up to 96.74. They're only a few dollars away from here. So if we repeat today's price action, I wouldn't be surprised to see $100 overnight. It's really the multi-year supply deficit, the booming industrial demand, especially EVs, AI, solar, the rising investment demand as geopolitical risks, the dollar weakening a bit, it creates that perfect storm where the demand really outpaces the supply and it pushes things up to record prices. Now, could prices pull back? Some pullback is definitely reasonable given these rapid price gains, but the fundamental underpinnings of the metal are really remaining in place. So we believe that any kind of dip would be shallow and be bought up.
Okay, so until otherwise noted, trend looks good. What about for coins? Should crypto folks be worried that, this thing has been range bound while there's so much action elsewhere?
So tough. It was building a base here in like early January, and then it shot up to about 98,000. Now we're getting this breakdown in that market again. We had a lot of leveraged unwinding. I was reading about $1 billion worth of positions of leveraged longs across various crypto exchanges were mechanically accelerated as far as the down move because of the fact they were forced liquidations being automatically sold off. So you do have some institutional slowdown. People are saying like, hey, I want to allocate. Remember when it was going up to like 125, people are like, I want to have a 10%, 2%, 5% allocation towards Bitcoin. And now that's being chopped in half, and it's probably being substituted out for some of these metals like copper, gold, silver, things like that.
I think it's a fair point because it's just, again, it's what role does it play? And the more murky it is on figuring out what that is, even the fact that, it used to be the pure risk where stocks are making highs, you can assume that Bitcoin's doing the same. But a year in which that doesn't happen, you start to question one of the most reliable things. It's like, it's fine if it's a thing that you use for additional beta. But when that becomes even in question, where stocks are, disconnecting a bit to the upside, it's hard to figure out kind of what the appeal is. Maybe it's just kind of a random chance thing, but I would think that while there's speculative appetite in silver and gold and commodities and plenty of stocks, that Bitcoin's probably going to be able to at least hold this range. Like, I don't think it's a bearish chart necessarily in the near term.
I don't think so either. I mean, if as long as it can hold some of the key levels, and I think what you really want to do is broaden and start to look out. Like, look at Ethereum. That's got more fundamental uses, things like that, from a platform standpoint. So if you start to see Ethereum hold some of these levels, start to push up again, Bitcoin will probably be the one that quickly snaps back as investors go into that. XRP is another one that, it seems to have these quick upward movements, then back down as well. So there is some volatility there. It's just, that one's just got to be put on the back burner at the moment. Again, like copper and things like that, there's too many better choices out there than to park your money in something like Bitcoin.
Fair enough. Phil, I want to get your thought on WTI, crude oil down 2%. A chart that just still seems like it is a sell rallies type of thing. I've had this line on here for a while. It's a pretty simple one, but it's, I don't know, am I oversimplifying, or is it just U.S. production, whenever there's a ramp, you sell it?
I have the same line drawn on my chart, and it's really since the start of 2025, futures prices were in this steady downtrend. You had one of the most insane events take place where we're dropping bombs on a nuclear facility in Iran.
Man, oil's not moving.
And futures they capitulated at $80. So that, to me, is the ceiling. You do have, Venezuela most likely going to come back online, start pumping more crude oil, getting things out there. You've got the U.S. producing a record amount. You've got global oversupply. The demand, yes, the economy is doing well, but it's more steady demand that's out there. And that supply is continuing to create this market surplus. And we expect that in the first half of 2026. So OPEC has also shifted their strategy where they're willing to tolerate lower prices, but they're going to throttle more. They're selling more pizza slices at that lower price, and that's where they're gathering that market share. And what it's doing here is it's just keeping this market well flooded with oil. So I believe that, yes, we had a little bit of a rally here, some geopolitical tensions, but it seems like the current administration is able to temper some of these fears, and prices should be back between $50 and $55, I think, in no time.
Okay. So maybe try it for a short here for $9 maybe?
I think so. But remember, when you're picking tops, you're picking bottoms, it all comes down to risk to reward. You've got to have a stop loss in place. You've got to, plan your trade your plan, either look at a calculated risk put spread, a short futures with a stop over the high, or something like that, something covered. You really don't want to leave yourself open-ended because of the fact that things can quickly deteriorate quickly as far as the geopolitical concerns.
I'm kind of thinking maybe this whole Greenland thing might be like the funniest geopolitical sell-off yet. You know, the memes are good. The memes are great. We got like, winter is coming, Game of Thrones memes. We got Marco Rubio wearing Han Solo, on the ice planet stuff. Like, the memes are good. But in my mind, it's just if some of the things that we've been through, like to your point, massive global conflict in a lot of places, maybe not U.S.-centric, but things that we keep shrugging off. I get that it's not good to be, kind of being, confrontational with Europe, our closest allies. Like, I get why that can freak people out, but it's Greenland. Also, like, when we see the data that keeps coming out, U.S. has continued to leapfrog the rest of the world since COVID. We've innovated all the best tech that's powering all the global innovation, essentially. We're pumping all the crude oil now to try and keep energy prices down, to help keep inflation down. I'm thinking maybe we deserve Greenland, and if we don't, then, who cares? Like, either way,
Yeah, I mean, from a strategic standpoint, I see it makes sense, and also developing some of those rare earth elements and things like that. We've got to get more diversification from, relying just specifically on China for some of these rare earth elements. And a lot of these different countries and nations out there, they have the elements that are there. They just don't have the infrastructure to bring them to the surface. And that's why we've formed some strategic partnerships with countries like Australia, countries like Canada, and then looking at things like Greenland. Greenland will give us a great advantage as far as maybe taking down some of these geopolitical risks because of the fact that we'll have bases around there. And I think that Europe should find some comfort in that. When President Trump says things like, we're going to take Greenland and stuff like that, people envision a worst case scenario there, but he's often the guy who comes out and he just says things, off the cuff, they get misinterpreted, and then he dials it in. And it was really, we just need to have some locations there. And I think that it'll help alleviate some of the geopolitical tensions and concerns.
That's fair. I can get some of that argument. I'm kind of like in the camp where, like, in terms of the things that matter for the S&P 500, I still think the argument is that it's fairly low. Now, I try not to be like totally myopic, the guy who doesn't care about anything unless it can break the market cap weighted U.S. stocks, but that's also kind of like my job a little bit. So when I think about kind of the ranking of things, I look at the semiconductors that are strong, I look at the innovation that's still happening, productivity going up, and all of these things suggest to me that it's going to take a lot more to break this market, especially when we had fairly shocking tariff announcements earlier in the year, and that couldn't even break the market. So, it's just try to fade on the Greenland stuff at your own risk is kind of my point.
April was a bit more sticky as far as working through that, because it was the first time we've seen the tariffs and how aggressive they were, 150%.
And numbers that were way above expectations, right? There was a big element of surprise there.
Yeah, in the volatility index continuing to surge higher, where what we've seen now is that since then it's been mostly like episodic and non-trending events that have occurred, and it's resulted in buy the dip mentality, forward looking here. Yes, AI, the NASDAQ got a bit ahead of itself. You saw earnings growth. It peaked in late 2023 as far as the Mag 7 and has rolled over, since October of 2025. So traders have rotated out of many of those consensus names on valuation concerns. There are some smaller cap, micro caps, things like that within the tech sector, AI plays that are creating some alpha. But the rotation's really been into the Russell 2000, which I believe only a couple hundred points away. This thing should be called the Russell 3000, because I think that's where we're going. It's going to be, the declining.
I like that.
The declining interest rates, the strong U.S. economic growth, the improving credit conditions, historically attractive valuations in comparison to the large cap dominance that we've seen. So I just think that Russell is there. There's probably too many people that are still short that. And if you start pulling small businesses, I mean, look at guys like, look at Blue Line Futures. Look at your, what you've developed and things.
AI, baby, high productivity,
Yeah.
Small business getting up off the ground and running. I love it. The Russell 3K. Phil, you the man. Great to catch up. We got to jump. We got the great Mr. Scott Bauer on deck. Thank you, Phil. Always good talking commodities in particular. You guys are all over that. Love it. Chief Market Strategist at Blue Line Futures, Mr. Phil Streible, looking at the Russell 3K. I'm going to bring Scotty Bauer right in on the Zoom, joining us from Prosper Trading Academy. Scott, what do you think? Should we be calling it the Russell 3000? Is this the new leader for the market?
It's really, really interesting that you're talking about that, because I was just looking at a stat, literally about 15 minutes ago, that since 1928, there have been 8 times that the first 3 weeks of the year, the Russell has outperformed the NASDAQ. Mm-hmm. Okay, 8 times. Didn't bode well for the NASDAQ, or excuse me, for the Russell the rest of the year. Not that it wasn't positive, but in none of those cases did it continue to outperform.
Interesting.
So,
So,
is it?
What do they call it? A brief, shot in the dark, a flash in the pan. Well, here's the thing: is that
but nonetheless, sorry.
No, you're good. I mean, it would require a big shift, right, from this super concentrated tech market that we've had.
For sure. And listen, the Russell lagged for such a long time, right?
Yeah.
That we were all kind of waiting for this to happen, and it's happened. It's made a monster move, especially compared to the other indices. I'm not so sure it can keep up. It would be pretty normal, I guess, at this point now that more cuts, not off the table, but probabilities are pretty low. So it would be pretty normal at this point to see this level off until if we get into another rate cutting cycle.
Now, that seems like it's coming, right? I think that's part of the reason why yields ripped, which is something we talked about a few weeks back, which was the 4.2% on the 10-year. If you've got a guy who's coming in politically motivated to just do the bidding and slash rates down, I think that actually pushes yields higher. And it seems like we're getting some of that realized. So, to your point, there's a potential complicating factor here. But does it have the power to, bring down the market per se?
I don't think it's going to bring down the market. I truly still think that tech is the leader here. Listen, next week we get big earnings: Apple, Meta, Microsoft, followed by Alphabet. Afterwards the following week. So I think that is still going to be a very big indicator of where the market is going to go. Not that we should or could discount the Russell, but that to me is really still going to be kind of a leading indicator.
Yeah. The small cap kind of diversification still is something that's fun, because I do think it tells us that we've got risk appetite, whether it's the Russell, whether it's silver, whether it's gold, whether it's Micron or an Intel, one of the few of the tech companies that's been making highs. People are not, bulls of various forms are not going down without a fight right now. That much is for sure. It just might have moved a little bit.
Oh, no doubt. No doubt about that. And listen, the trade that we went through for the better part of last year, at least, summer on, of this market responding to news, to tweets, to Truth Social posts, to whatever it might be, that market is back again. It really is. So I think everybody just has to kind of be aware of that, right? That at any one point, we could see a market move 2%. Now, is it as intense as it was a year ago? Probably not. However, it is still there. It is absolutely still there. So I think it'd be very, very prudent for people to really look at that and say, okay, we need to just be prepared. I guess as a trader, you always want to be prepared. You always want to have those bullets. You always want to kind of, be a step ahead of the game. And
Yeah.
I think we can't let our guard down.
To that point, and this kind of comes full circle with where we began our show with Brent Kochuba, is looking at VIX. You know, the move to 20, to your point, in this sell-off this past week, and pop and VIX, very, very small compared to even what we had in the fall, or especially the spring of last year. But, you know, there could be some still rattling of the cage that needs to happen, and 15.6 for VIX looks like there might be some cheap options out there to be prepared again.
Oh, there's no question. I mean, truth be told, I bought yesterday. I bought the VIX yesterday. I know it's down a little bit today. 15.6, high teens is probably very, very warranted. Mm-hmm. So I think that, you know, it definitely pays to do that. And you know, who would have thought, Oliver, that some of the chip stocks, not so much Micron, AMD, but SanDisk, some of these other ones that have had these runs, which are, you know, unbelievable, absolutely unbelievable. Who would have thought that we could have that? And I can see that they could easily give back 15-20% just as easily as they've climbed this much.
The real swingy ones.
For sure.
You know, to your point, S&DK, just pull it up here. Places where maybe that is worth having a hedge on. Does it make sense to maybe hedge your overall stock exposure through one of these kind of high-flying single names going into earnings?
Either that or even like an SMH, right? Where you don't have to necessarily just choose a particular stock and maybe looking at more sector related. But yeah, I think you do need to have somewhat of a hedge there because it's cheap. It really is cheap. And to not have that hedge, that's the kind of thing that can drive traders. And even if you're just an investor looking to hedge, you know, an overall portfolio, that's the kind of thing that can drive you nuts. You ever get into that shoulda, coulda, woulda situation, right? And we've all been there, whether it's to the upside or to the downside, which is why you have to be opportunistic and you have to take advantage of situations like this, which in my, you know, kind of estimation here, is cheap volatility.
Yeah, I like that point because we do still have a good bit of reports that have to come out. You know, in terms of the tech trade, you've got a pretty busy couple of weeks here to close out this month. NVIDIA held 180, you know, which was key. But to your point, that hasn't been the big mover. The higher flying stuff likely to have more potential for some volatility both ways. So that might be the story of the next month here is how they respond to earnings. Maybe take a little short-term flyer and a put to try and hedge out the overall market position. I like that point, Scotty. Thank you very much, sir.
Always my pleasure.
Great stuff, Mr. Scott Bauer, Prosper Trading Academy. You heard the bell. Equities hung in there for the day. The S&P 500 added about 0.5%, 37 points. Thanks for watching Chicago Future of Finance. I will see you on Tuesday at 2 p.m. Thanks for tuning in. Have a great night.